When you hear about diplomatic talks breaking down halfway across the world, it can feel, well, pretty distant, right? Abstract. But here's the thing. Those failures send immediate shockwaves right into the global economy, and believe it or not, right into your wallet. Today, we're going to connect those dots.
And that's really the big question, isn't it? How can one single political event, a negotiation in one city, trigger a massive financial chain reaction? A reaction that touches everything from the price you pay for gas to the value of your savings. So let's trace that chain reaction, step by step.
All right, so here's our game plan. We're going to follow the 5 key ripples spreading out from this event. We'll start with the deal that fell apart, then ride the oil shockwave, see how supply chains literally break, watch the markets teeter on a knife's edge, and finally figure out what this all means for you, the investor.
Okay, so every story has a beginning, and for this market earthquake, the first tremor was the collapse of these high-stakes negotiations. This is the moment that turns some cautious optimism into outright conflict.
Just think about how fast this all went down. On April 7th, we get a ceasefire. There's this little glimmer of hope, right? But then, just a few days later, after more than 20 grueling hours of talks in Islamabad, it all falls apart. And by the 13th, the response isn't just words, it's a full-on naval blockade. The situation escalated in the blink of an eye.
So what was the sticking point? Why did it all collapse? Well, it boiled down to this one huge disagreement. The U.S. was demanding that Iran completely dismantle its nuclear enrichment program. For Iran, that was a non-starter, a red line they just would not cross. And with neither side willing to budge, that single point of conflict set the stage for everything that happened next.
And you guessed it, the very first place we see the economic fallout is in the lifeblood of the global economy, oil. The diplomatic failure immediately turned into a direct threat to the world's energy supply.
And the epicenter of all this? It's a tiny sliver of water called the Strait of Hormuz. This narrow waterway between Iran and Oman, it's not an exaggeration to call it the most critical choke point for global trade on the entire planet. Its importance is just massive.
Let this number sink in for a second. A full quarter, 25% of all the oil the world uses every single day has to squeeze through this one tiny bottleneck. So any disruption here isn't just some minor hiccup, it's a direct shot at global energy security.
And make no mistake, this wasn't just diplomatic posturing. This was a direct, unambiguous statement of military action from U.S. Central Command. The language is crystal clear. It sent a signal to the markets that the flow of oil was about to get shut down by force.
So what did this do to prices? Well, take a look. The market absolutely freaked out, instantly. During that brief ceasefire, prices had actually cooled off, down to around $95 a barrel. But the second those talks collapsed and the blockade was announced, bam, Brent crude shot up to over $107. That's a jump of 7 to 8%, almost overnight.
But a shock to the oil market is never just about oil. It's the first domino in a much, much longer chain. The blockade started a logistical nightmare that began to snap the fragile links of our global supply chains.
And you can see exactly how this chain reaction works. First, ships have to be rerouted, taking longer, more expensive journeys. That, of course, means deliveries get delayed and ports get clogged up. At the same time, the cost to insure these ships against risk goes through the roof. And where do all those extra costs end up? They get passed right down the line, all the way to you, the consumer.
And we're talking about way more than just oil here. This region exports tons of other key materials, things like fertilizers and petrochemicals. So suddenly there are shortages of those too. And it's not just physical goods. The conflict also triggered warnings about major cybersecurity risks. So the takeaway is pretty clear. Messing with one critical choke point sends ripples that disrupt pretty much every industry you can think of.
Okay, so oil is in turmoil. Supply chains are a mess. What do you think happens next? Yep, Wall Street gets nervous, really nervous. Any optimism, any so-called peace dividend that had built up, just vanished in an instant.
And talk about whiplash. The contrast is just, wow. During that little ceasefire week, the market was euphoric. The S&P was up 3.5%, emerging markets were up over 7%, even Bitcoin was up almost 10% while oil prices were falling. Then the talks fail, and it's like a switch flips. Everything reverses. Volatility spikes, and all that green on the screen turns red.
What we're seeing here is a classic textbook flight to safety. When things get scary, investors dump what they see as risk assets, stuff like stocks, crypto, and they run for cover in traditional safe haven assets. These are things like the US dollar, gold, and government bonds, things they trust to hold their value when everything else is going crazy.
Now, this brings up the big question about Bitcoin. For years, we've heard it pitched as digital gold, a new kind of safe haven. But when the rubber met the road in this crisis, it acted nothing like gold. Instead, it behaved just like another risky tech stock, getting dumped by investors who were trying to avoid risk at all costs. So, okay, things are chaotic. The markets are on a knife's edge. If you're an investor, what on earth are you supposed to do? How do you even begin to navigate this kind of uncertainty?
And this quote right here, it just nails the dilemma every investor is facing. You're terrified of the downside. I mean, the potential for big losses is very real. But at the same time, you have this massive fear of missing out on a sharp rebound if things suddenly get better. It is an incredibly tricky spot to be in.
So, let's break down some of the practical advice floating around. The big one is to avoid making huge, aggressive bets one way or the other. It's just too uncertain. With bond yields rising, fixed income starts to look more appealing as a defensive move. And big picture, don't expect the Federal Reserve to ride to the rescue with rate cuts anytime soon. They're seen as being firmly on hold.
And it's so important to remember, this isn't just a game for traders. The World Trade Organization connects it directly to the real economy. They're warning that if oil prices stay this high for too long, it could literally shave 0.3% off of global economic growth, with places like Europe that import a lot of energy getting hit the hardest. This is geopolitics hitting home. And all of this really brings us back to one big final question. We just saw how a failed negotiation in one part of the world can make it more expensive to fill up your car and can mess with manufacturing thousands of miles away. It really makes you wonder, in a world this interconnected, is there even such a thing as a local conflict anymore?